Hi, this is Michael Joyce from Agili, and I'm pleased to share with you our thoughts and viewpoints for the fall of 2020. And what a crazy year this has been. So let's recap it a little bit. So we started the year, the economy was going great guns, the markets were at all-time highs, and things were really looking great. And then everything changed. You know, the pandemic hit with the coronavirus, and in a matter of 6 weeks from mid-February to the end of March, things just dropped dramatically, with the exception of long-term Treasury securities. But before that hit, we had actually been pruning some positions in certain stocks that we felt had reached pretty full valuations. And then as we got into the downturn, we felt that there was a lot of opportunities out there. So we took advantage of a lot of these opportunities in the stock and bond market. So where we are as of the end of September, the markets have, at least the US stock market, for the most part, the indices have recovered the downturn. Our clients have a return that looks like a V shape, but that's not really how it looks on Main Street. You know, the economic recovery has been much more muted, and we still have a long way to go with any kind of economic recovery. So at this point, you know, we are in a position that we are being much more cautious than we were in March and April, when we did see a lot of opportunities. And I think it bears mentioning that even the gains in the stock market may not be all that they've been cracked up to be, because they've really been led by one sector, and even just a few stocks in that sector, and that's the technology sector. So that's really been what's been dragging the indices upwards. The median stock on the S&P 500 as of September 30th is down about 11% year to date. You have sectors like the finance sector, where it's down 20 to 40% year to date. The energy sector is down 48% year to date. That's worse than cruise lines. It's worse than airlines. It's worse than hospitality. A lot of the areas that we really think of that were negatively impacted by the coronavirus. And like in the U.S., international stocks have also recovered pretty significantly. I mean, they're down for the year, but they've recovered quite a lot. And what has been kind of a performer that people haven't been paying attention to, but has done particularly well in the past couple of months, are the emerging markets. You know, the emerging markets, particularly the Asian emerging markets, have really recovered substantially, and were probably the best performing asset class in people's portfolios for the third quarter of the year. Likewise, in the bond market, things have changed a lot. We did see a lot of opportunities in the March and April timeframe, but now yields have really dropped significantly. The majority of all bond yields are now below 1%, and that's really not that great. You know, I mean, if you think that the Fed's target for inflation is 2%, you know, most bonds are going to have a negative return after you account for inflation. So where we are right now is, for the long term, we're pretty optimistic. And that's good news for people that are long-term investors, people that are trying to meet their long-term goals and objectives. And one of my biggest sources of optimism are these super low interest rates. First of all, you know, when you have low interest rates, you can discount future cash flows from companies, a lower discount rate, which creates higher price earnings ratios. So you can have higher valuations with lower interest rates. But I think more importantly, when things start to recover more, that we will see a lot of investors have a lot of cash on the sidelines. There's still trillions of dollars. There's over $4 trillion of money still sitting in cash, earning about zero. So as some of that money starts to come out, I think they're going to be looking at good dividend-paying stocks. You know, stocks are paying 3% dividend yield, 4% dividend yield, 5% dividend yield. If you want to buy the venerable stock Exxon, you can get a 10% dividend yield on that right now. And I think all those are going to look very attractive compared to sub 1% rates on high quality bonds and treasury securities. So there is that long-term optimism. But what we have before that is this presidential election. And in every presidential election year, we get a handful of clients that call us, and some will say, if the Democrat wins, I want to sell everything. And some will say, if the Republican wins, I want to sell everything. And really, that doesn't matter much who wins. But this year, we think there's an issue with not so much who wins, but who loses. And that whoever loses will portray the election results as maybe rigged. And there will be a substantial part of the population that thinks the election results are illegitimate. And that can create some chaos. We're calling it election chaos risk. And the markets don't like the uncertainty with any kind of thing that says chaos. So we want to be careful about that. We want to devise some strategies perhaps to hedge that risk to get beyond beyond January. So we are looking at those types of things, whether it's hedging with index options or taking other measures to hedge certain risks along the way. We're also it's the beginning of October, so we're getting closer to the end of the year. So there's a lot of things that people can do before the end of the year to optimize their financial situation. And one of the things to look at is taxes. They seem to talk about taxes every quarter, but now is the time to look up, are there losses to match up with gains that might have been taken earlier this year? Certainly, as I said, we pruned some positions and took some gains, so we're looking at matching up those losses with gains, making sure that short-term losses match up with long-term gains, etc. There's also other things to look at, whether it's with qualified opportunity zones, which is something in the tax code that can defer capital gains through 2025. This is a good time of year to start looking at these different strategies which will result in a lower tax liability for you. It's also the time of year to look at things like charitable gifting, to look at Roth conversions and those types of things. And we want to make sure that those things happen well before the end of the year, because all the custodians really get jammed up before the end of the year. So we don't want to be in a situation that we're late in December and you want to make a gift of appreciated stock and the custodians are saying that they're going to do it on a best efforts basis. We want to make sure that we're ahead of the curve and we have this in place beforehand. So these are just a couple things to think about. There's actually far more things to look at before the end of the year. So I would really encourage you to talk to your financial strategist at Agili. And I'm very pleased to have shared with you our thoughts and viewpoints for the upcoming months. If you do have any questions, feel free to contact me or feel free to contact your financial strategist at Agili. You can always see new things that we're thinking about on our website, agilipersonalcfo.com, or via Twitter. Thanks a lot. Have a great day.